Nice to meet you, everyone, and thank you for that introduction. So I'm here to talk to you today, there we go, about what will fuel the next wave of innovation. So it's a big question to ask, and I think before we can answer it fully, we need to understand what actually fuels innovation today. So there is an organization which looks at this professionally, a pretty trusted one called the WIPO. They produce a global innovation index every year. And currently, to the year 2023, they have published these countries as the top 10 innovation centers. Now, why are these countries leading the rest when it comes to innovation? The report is huge. I highly encourage all of you to check it out and look at all the data points. But when you slice all of it up, it really comes down to a handful of attributes. And that is the availability of capital, the income level. These are all high-income countries. And that's important because when you think about it, most innovation actually happens at startup or private entities. And most of those ventures usually start up by having a friends and family round of funding to actually get going in the first place. In addition to that, a strong business legal framework. You've got to be able to start a company pretty easily and ideally administrate it pretty easily. You've also got to be able to hire people easily and ideally fire them easily, especially in a startup venture. If you're in a country where you can't fire people easily, then you can't really hire anyone either. And ideally have access to a high education of workforce. Now, the bottom three, the business legal framework, employment law, and education, they can change, and they do change, but really slowly. So I don't think that those are going to be the catalysts which really drive a wave of innovation. However, the availability of capital, that's interesting. So let's look at that a little bit more. Let's divide the world now into private and public companies. So just to bring everyone up to speed, private company, your typical small enterprise, which could be quite a large enterprise, in fact, but the definition is it's private. A public company, anyone here can go and buy shares or debt instruments from a public company. It's public, any member of the public. A private company has control over who becomes a shareholder. It's their decision. At its core, that's the base definition. Now, when you segregate the world into that, the number of private companies in the world is about 99.9% of them. If you look at the US just as an example case point of a highly evolved capital market society, there are 6 million private companies that have employees. There are about another 25 million that don't have employees. They're just single sole traders. Let's exclude those because the innovation is probably going to happen at places that have employees. So it's about 6 million as opposed to 4,000 public companies in the US. That's a staggering difference. However, when you look at the employment, it's still skewed. It's slightly more balanced, but still skewed in the favor of private companies, about 22%, because those public companies are much bigger and employ more people. But private companies still form the greatest amount of employment in the US and globally. But when you look at the amount of investment or the market value of those entities, actually it's completely skewed the other way. So we have 8% of global market value, or about $13 trillion, in private entities, in private markets, as opposed to 92% of the investment value of the world is in public enterprises, or 0.01%. It's staggering. It's absolutely staggering. And so when you think about that from portfolio theory, okay, I'm not going to get too technical here, but from the perspective of a large asset manager, modern portfolio theory is essentially that in order to optimize your portfolio to get the best balance of returns versus risk, you need a diversified portfolio. But what's actually happening here is there's massive concentration risk. And what really moves the needle are pension funds, other huge institutional asset managers that have this huge concentration risk in the tiny portion of public enterprises with most of their investment value. Why? It's because of something called liquidity risk. So liquidity means the ability to transact in something fairly easily and freely. In public markets like the London Stock Exchange, NASDAQ, New York Stock Exchange, etc., you can place an order and you're pretty confident it's going to be executed. And if it's a huge order, it's probably going to take a few days, but it's going to get executed pretty well. Whereas in private markets, that doesn't exist. So let's drill into that a little bit further. And is that changing? So liquidity risk, it's really, you can broadly segregate it in, are there sufficient buyers and sellers versus how easily can I actually transact? So first off, on sufficient buyers and sellers, in public markets, we just mentioned them. Huge marketplaces, centralized, London Stock Exchange, Hong Kong Stock Exchange, NASDAQ, New York Stock Exchange, etc. And derivatives exchanges and debt exchanges and so on. That hasn't existed in private markets until recently. So NASDAQ launched NASDAQ Private Market 10 years ago. And over the last 10 years, NASDAQ is not solely responsible for this, but it's representative of a general shift. Over that last 10 years, there has been an acceleration of the value of private markets in total, so investment going in, versus public markets of 1.7 times. So almost double the rate of growth in private markets versus public markets. Now that's still coming off a low base versus public markets. So is there anything that's going to shift the needle much more rapidly? Let's come back to that. Ability to transact. So first off, let's just take a quick look of how transactions actually happen in public markets. If someone's selling and someone's buying, they go through their broker. Those brokers both have accounts on the exchange, and that exchange matches those orders. When there's a match, then the buyer and seller go, or the brokers go, okay, how do we actually know that the other person's going to deliver what they say they're going to deliver, the cash or the securities? Well, there's an entity called the clearing counterparty for that, or a CCP. There's a central body that do that in every country. And then once that body is comfortable that there are, the seller has the securities to transfer and the buyer has the cash, then who's going to take responsibility for actually transferring that? That's called the CSD, or a Central Securities Depository. And that's really like a massive warehouse of electronic deposit boxes. It takes cash out of one and puts it in the other, and takes securities from the other and puts it in the other. So there's this central trusted authority that does all that. It creates trust in the marketplace. And that sounds like a lot, but it's actually highly efficient. These have been developed over the last 50 years. And it works really well. There are a lot of people that say it needs to be optimized, but actually it's good. In private markets, however, if there are two parties that want to transact, they go, hey, hang on, I'm not going to hand over the cash until I know that I'm getting those securities. And you're not going to give me those shares or debt instruments or whatever until you know that you're getting the cash. So how do we do this? There's no central authority. We have to get a lawyer. We have to both sign legal contracts to make sure that we're both comfortable and we're legally bound to do whatever we say we're going to do. We have to then put the cash in safe holding somewhere, and so there's a third party that needs to safeguard that we both trust. Then we've got to do AML checks, because I don't want to get in trouble for accidentally dealing with a terrorist or a drug dealer or something like that. Then we, again, private securities, right? So the company needs to actually approve the transfer of legal title. So the company needs to be involved here. And then once that's done, it actually needs to be effected, which in some cases is, to be legally settled, it requires generating new share certificates or paying stamp duty in the UK or whatever else per security per country. It's a lot. It's a very manual process. And there's a huge amount of friction there, as I'm sure you can see. So I founded a company about 6.5 years ago called Globacap, and we automated that. We took each one of those processes, we fully digitized it, and we automated the workflow throughout of it. So it became, instead of humans doing functions, it became button clicks and automated processes that complete with regulatory components, such that in the space of microseconds, everything's done. We also then extended that, and we did that for primary placement, or rather the investment of new capital. Things like signing NDAs, data rooms, signing subscription agreements. Instead of, if there are 100 investors in a particular transaction, why is it that there is a lawyer who's sitting there creating 100 individual subscription agreements for each one of those end investors, plugging it into DocuSign? That's a lot of manual workflow, which is, no one should be doing that. So we automated it. We created, dynamic fields and someone can load in a subscription agreement. We connect into DocuSign. Platform takes care of everything. We also did that for ongoing administration of vehicles, private equity vehicles, venture capital vehicles. One of the biggest pain points in private equity world is managing capital calls. In a private equity vehicle, if you have an investor that comes in, they actually don't give you all the cash on day one in the private equity fund. What they do is they commit to what's known as capital calls. So at certain points in time, on certain conditions, they'll transfer you in cash that you can then, as a private equity manager, invest in those assets. And so if you have 10, even 10, if you have 100, if you have 1,000 investors into your private equity vehicle, that is an administrative nightmare to be able to actually draw down those capital call payments. But then what about if one of those investors wants to transfer their actual holding in the fund to someone else? That's an even bigger administrative nightmare to be able to do that. So again, we made all of those data points digital, and then we automated that right at the upfront where the investment happens, and then right through the ongoing management to actual secondary transferability such that it happens instantaneously. And so we then deploy that for entities around the world, like exchange groups. So the Johannesburg Stock Exchange launched a private placements platform 18 months ago, which is on our technology. They run that marketplace with 2.5 full-time people because basically everything's automated. And we're working with other exchange groups around the world as well as securities firms, advisory firms, and directly asset managers, so private equity firms like managing those capital calls and other types of administrative overheads. So I think the picture I'm trying to paint here is that world that's extreme, that forms a huge section of the foundation of our economy has been highly manual and laborious, is changing. That's changing right now from us and from other providers out there as well. And we have introduced automation such the ability to transact is now becoming, all that friction's gone. And so that solves number 2, ability to transact. But what about number 1? So that number 1 is partially being solved by entities like NASDAQ Private Market. But in addition to that, we took the view that, okay, if we're deploying this technology for these massive institutions around the world, then instead of trying to create one single marketplace, why don't we just connect all of them together? And we did. So those entities that use our tech are now starting to speak to each other and transact directly with each other for shared deal flow and shared distribution or investor flow. And so that starts to solve sufficient buyers and sellers. Now, this is really at the beginning of a wave of digitization in this space, and there's a long way to go. But if we go back to our original slide, and if that needle moves now, if we start to accelerate that transition because that liquidity risk is changing, that means as a big asset allocator that I'm sitting on a pension fund on 100 billion that I need to allocate, and I go, hang on, this liquidity risk is changing, I've got all this concentration risk here, well, okay, I'm going to reallocate 10% of my portfolio from public into private markets. Great. So if that balances from 92% public markets to 85%, that's an additional $25 trillion that moves into private markets over the next decade. How much innovation does that fund? How much innovation does that fuel? When you think about all the innovation that happens now, a little bit happens in big companies, but really the majority happens in startups that get bought by big companies. So that's more than double the total value, or that's about double the total value, of the whole private market space right now. What happens if that rebalances to 50-50 over the next decade? That's $63.5 trillion that gets reallocated from public markets into private markets. How much innovation, how much employment, how much growth in our economy does that actually fuel? We are on the verge now of not just a massive uptick of fuel and innovation, but actually the biggest rebalancing of capital that has happened in the space of economic recorded history. It's absolutely astounding. And I hope you can feel my excitement from that. Thank you very much.